Assalamualaikum warahmatullahi wabarakatuh. My name is Arina Syara binti Muhammad Kaizi. So today I would like to present about Islamic finance. So what is Islamic finance? Islamic finance refers to how business and individuals raise capital in accordance with Sharia or Islamic law. It also refers to types of investments that are permissible under this form of law. Islamic finance can be seen as a unique form of socially responsible investment. So right now, we will be talking about the difference of Islamic finance between conventional finance. In Islamic banking system, real asset is a product and money is just a medium of exchange. And profit on exchange of goods and services is the basis for earning profit in Islamic finance. Furthermore, balanced budget is the outcome of no expansion of money in Islamic finance. Moreover, in Islamic finance, loss is shared when the organization suffer loss. Lastly, in Islamic finance, the execution of agreements for the exchange of goods and services is must, while disbursing funds under murabaha, salam and istisna contract.
Okay, my name is Nisha. So in this presentation, we will compare the Islamic financial system and the conventional bank. Aina just explained to us the Islamic financial system, so I will explain the conventional bank system. Okay, the differences on the conventional bank is based on fully man-made principles. It's profit-oriented and its purpose is to make money through interest, whereby it uses interest charger to lenders along with the other investments to turn over an income. In conventional banking system, money is a product besides medium of exchange and store of value, and its time value is the basis for charging interest on capital. The expended money in the money market without backing the real assets results deficit financing. Moreover, in conventional system, the interest is charged even in case the organization suffers losses, thus no concept of sharing loss. Other difference on conventional is while disbursing cash finance, running finance, or working capital finance, no agreement for exchange of goods and services is made. So, the next presenter will explain to you the structure and operational mechanisms of Islamic financial system.
So we go to the operating mechanism of Islamic financial system and conventional financial system. For Islamic financial system, the mechanism is to mobilize funds from the surplus fund that channels those funds to the deficit fund unit that must be done within the parameters stipulated by the Sharia. In other words, the whole process, instrument, activities of channeling fund must be follow the rules and the principle prescribed by the Sharia. For conventional financial system, the operating mode are based on fully man-made and secular principle and not based on any religious law or guidelines. The financial institution, including Islamic bank, where it is compared with conventional banks. Besides, the comparison between the takaful companies with its alternative to the insurance company, mutual fund, and other Islamic finance companies facilitate the flow between the surplus fund unit and deficit funds units by developing instrument, technique, and products that not only meets the needs of depositor and customer, but more importantly, it is compliant with Sharia. These are the basic Islamic financial system. The first one is the prohibition of the interest. The general consensus among Islamic scholars is the riba covers not only usury but only the charging of interest are widely practiced. Next is the prohibition of the speculative behavior of the gharar. It means that uncertainty and ignorance of one of both parties in the contract. Lastly, the Sharia is approved activity which is to avoid speculative of the maisir. For example, any investment of business dealing with the alcohol, gambling, and casino will be prohibited. Next is the existence of the Sharia Supervisory Board. Each Islamic institution like bank must have the Sharia Supervisory Boards as it is the main component of the Islamic bank. Malaysia is the under National Sharia Boards together with the Pakistan, Sudan, and Indonesia, where it is the overall authority of the Sharia government framework and policy. The role of the Sharia Supervisory Boards are the first one is to provide fatwa that certify the permissible financial products. Next is to undertake the Sharia audit to ensure the products are comply with the guidelines. The third one is to calculate the zakat payment. Next is to dispose of non-Sharia compliant income or earning. The next of the role of the Sharia Supervisory Board is to provide advice to the bank on the distribution of income to the shareholder or depositor or investment account holders. Lastly is to provide guideline to the bank on its wider social role.
Assalamualaikum and hi to my fellow audience. My name is Zulhanizam bin Zulkhairi and today I would like to present about the structure of Islamic financial system versus the conventional financial system. Okay, for the first one, we're going to take a look about the general structure. The Islamic financial system is an ethical banking system focused on Islamic Sharia law and its practice. Interest in Islamic financial system is absolutely forbidden. Islamic financial system operation must be on the structure of Sharia compliant. Okay, for the next one is we're going to take a look to the Bank Negara Malaysia regulation structure. Okay, the beneath IBA, Islamic bank must develop Sharia advisory service bodies. The Sharia is fundamental to these bodies. Bank Negara Malaysia of Sharia Advisory Council (SAC) is the independent authority for Sharia decision problem pertaining to Islamic banking and finance company, which fall within the competence of central banking. Bank of Negara Malaysia (SAC) will also serve as the main Sharia guideline ruling on Islamic banking in illegal cases and the cases of finance. And the next one is the structure of the Islamic financial system are being governed and supervised by Bank Negara Malaysia under the Islamic Banking Act 1983 or IBA, while conventional banks that participate in the Islamic banking scheme (IBS) are governed under the Banking and Financial Institution Act 1989, BAFIA. And the last but not least, another structure that may enforced in the regulation of Bank Negara Malaysia for the Islamic financial system is the Anti-Money Laundering Act 2001, AMLA. This enforced act has shown us the money laundering rules and know your customer policy defend the Islamic banking system against money laundering activities. AMLA provides robust regulation to deter, track and prosecute money laundering activities, perpetrator or property originating from or participation in money laundering and record keeping and reporting provision of suspicious transaction by Islamic financial system.
Hi guys, so now let's continue with the financial instrument. So financial instrument is defined as any contract that gives rise to a financial assets of an entity and a financial liability or equity of another entity. So for conventional financial instrument, it is the value of such assets that are based on their intrinsic value, which usually determined by the availability of the information, issuer's performance and ratings, targeted and extent of trade ability of the given instrument. Conventional financial instruments deal mainly on intangible assets that is represent legal claim to some future benefit. The typical benefit is the claim to the future. Islamic financial instrument, on the other hand, do not consider money as an instrument of trade. As such, it does not have intrinsic value. Any profit earned through dealing with money or the paper representing them is interest, hence prohibited. Therefore, the use of money in community is prohibited by Sharia, especially where they make gains without any effort or any form of risk. So there are a few products that are offered by Islamic and conventional financial instruments. So for Islamic capital market products are a wide range which include sukuk. On the other hand, conventional debt capital market products are bonds. So there are differences between sukuk and bonds. So let's take a look at the differences. Sukuk are backed by tangible asset and investors are given partial ownership in the asset with the actual value. Although bond may also indicate this, the ownership of a bond simply indicate a debt obligation. Next, the asset that backs sukuk must be compliant with Sharia. They cannot include investment that derive the majority of their income from the sale of the alcohol, pork product, gambling, military equipment or weapon or tobacco, as well as those that are transacted in unethical services such as banks and any other institution that are involved in interest-bearing activities. Bonds, on the other hand, can be used to finance any assets, project, business or joint venture that complies with local legislation. Next, for the pricing, the face value of sukuk is based on the market value of the underlying asset, whereas the face value of the bond is based on the issuer's creditworthiness, which include its rating. Next, the value in sukuk increase when the underlying assets increase, and conversely. with bonds, the performance of the underlying assets does not affect the bondholder. Lastly, for sales, when investors sell Sukuk on the secondary market, they are selling ownership of the asset backing them. For bond, when the investors sell the bond in the secondary market, they are actually selling a debt on the underlying loan relationship. For bond, when the investors sell the bond on the secondary market, they are actually sell a debt on the underlying loan relationship. Although some may argue that the differences between Sukuk and bond are merely technicalities, these differences matter to Muslims. In fact, the practice of profiting from money alone at the expense of productivity and the real people has been one of the drivers of the many economic problems. Sukuk, unlike bond, which are priced according to the real market value of the assets that are backing in Sukuk certificate, bond pricing is based on the credit rating of the issuer. This is necessary in the case of bonds because when you sell a bond on the secondary market, you are actually sell a debt in the underlying loan relationship. Meanwhile, the sale of Sukuk on the secondary market is simply the sale of ownership in the asset. Having understood of the Sharia issue with the bond, there is another instrument in the conventional debt capital market, which is asset-backed securities, which is ABS. In ABS, the owner of the income generating of the assets do not raise loans on the capital market. Instead, they raise funds by selling their own asset via securitization transaction, which must fulfill two important criteria, which is firstly is through sales, and secondly is bankruptcy remoteness. The sale of the asset must be true sale from the legal perspective. Okay, this table shows the differences between bond, ABS, and Sukuk.
So I'll be present about the difference between interest and profit and interest. So there are three points of the difference between profit and interest. So the transaction in trade comes to an end as soon as the article and its price change in hand. After this, the buyer is not required to return anything to the seller. Other than that, as regard the rent of furniture, house, land, the land thing is not itself spent up, but it returned to the owner after the term. But in the case of the principal, the debtor has to spend it first, then they reproduce it and return it to the creditor along with the interest. Thus, the debtor runs a double risk, and he has to reproduce the principal and also to produce its interest.